Welcome back to the channel. Today we'll be tackling a topic that's very crucial in your investment journey. Asset allocation. Asset allocation refers to how you divide your investment portfolio among different asset classes, such as stocks, bonds, and cash. It is one of the most important decisions you will make as an investor because it sets the overall risk and return profile of your portfolio. By diversifying your holdings across different asset classes, you can reduce risk while still achieving reasonable returns. Asset allocation helps smooth out the volatility of individual investments by combining various asset classes that don't always move in the same direction. For example, when stocks are declining, bonds may be stable or rising in value. The three main asset classes are stocks, bonds, and cash equivalents. Stocks provide the highest potential returns but also the most risk and volatility in the short term. Bonds generally carry less risk than stocks and provide regular interest payments. Cash and cash alternatives like money market funds are the most conservative but also offer the lowest potential returns. By carefully choosing the mix of these asset classes, you can build an investment portfolio tailored to your specific financial goals, risk tolerance, and time horizon. Periodically rebalancing keeps your portfolio in line with your target allocation and disciplines you to buy low and sell high. Let's explore asset allocation in more depth. When constructing an investment portfolio, the two main factors to consider are risk and return. In general, higher expected returns come with higher risk. The different asset classes have varying degrees of risk and potential reward. Stocks have the highest risk in the short term but have historically provided the strongest long-term returns of 7–10% annually on average. Individual stocks can lose 50–90% of their value during market downturns. Bonds generally carry less risk than stocks. Government bonds have very low default risk but provide lower returns of 3–4% annually. Corporate bonds offer higher yields but have greater default risk. Cash alternatives like savings accounts, money market funds, and short-term bonds have minimal risk of losing value but also provide very low returns near 1% or less. Their primary purpose is capital preservation rather than growth. By diversifying across asset classes, you can reduce overall portfolio risk while still achieving returns higher than any single class. A balanced portfolio with a mix of stocks, bonds, and cash can provide moderate growth with less volatility than an all-stock portfolio. This is the core concept behind asset allocation. A key step in developing an asset allocation strategy is understanding your individual risk tolerance. This refers to how much investment risk and volatility you are comfortable with in exchange for higher potential returns. Some questions to consider include: how long is your investment time horizon? More time allows for riding out downturns. What would a 10–20% short-term drop in portfolio value do to your emotions? Can you stick to your plan or would you be tempted to sell at a loss? How would you feel if it took 5–7 years to recover losses after a major market crash? Do you need investments that provide stable income or can you accept variability? Would you prefer minimizing losses over maximizing gains? Answering these types of questions helps determine if you have an aggressive, moderate, or conservative risk tolerance. Those with higher tolerance can handle more stock exposure, while conservative investors may prefer mostly bonds and cash. Understanding your personal risk threshold is crucial before developing an allocation strategy. You don't want to take on more risk than you can emotionally and financially withstand. Once you understand your risk tolerance, the next step is to develop an asset allocation strategy using the appropriate mix of asset classes. Here are some guidelines for common strategies. Conservative, low risk, 20–40% stocks, 60–80% bonds, cash. Moderate, 40–60% stocks, 40–60% bonds, cash. Aggressive, high risk, 60–80% stocks, 20–40% bonds, cash. Within each category, you can further diversify by investing in U.S. stocks and international stocks, as well as government bonds, corporate bonds, and other fixed income. Rebalancing your portfolio annually or semi-annually ensures you maintain your target asset allocation mix. This disciplines you to sell high and buy low, taking profits in well-performing assets and reinvesting in underperforming ones. For example, if economic growth is strong and stocks surge to 70% of your portfolio, you would rebalance by selling some stock gains and buying bonds. This locks in past profits while adjusting your risk level. Sticking to your strategic asset allocation through all market cycles is key to achieving your long-term investment goals. Tweaking it as your needs or risk tolerance change is also important. With the right allocation strategy, you can grow wealth while managing downside risk. Now that you have determined your risk profile and developed an asset allocation strategy, it's time to implement it. Here are some options to consider. Mutual funds target date, index, or actively managed funds provide instant diversification across many stocks and bonds. Look for low expense ratios. ETFs, exchange-traded funds, track indexes at low cost. Choose broad-based stock bond ETFs or build your own 3-fund portfolio. Robo-advisors, automated services like Betterment, Wealthfront, and Schwab Intelligent Portfolios implement and manage your asset allocation for a low fee. DIY portfolio, open brokerage accounts and purchase individual stocks, bonds, CDs, and other securities to build your allocation from scratch. Requires more work. 401k, IRA, employer retirement plans and IRAs allow you to invest in low-cost mutual funds to achieve your target allocation in tax-advantaged accounts. Choose low-cost investment options that match your desired asset classes. Automated services provide set-it-and-forget-it simplicity while DIY requires active management. Regardless of approach, periodically rebalance to maintain discipline. With the right implementation strategy, your asset allocation plan becomes your long-term blueprint for growing wealth while managing risk. Stick to it through all market cycles. While developing a strategic asset allocation is important, your needs and risk tolerance may change over the decades-long investment time horizon. Here are some reasons you may want to adjust your allocation. Age and proximity to retirement. Take on less risk as you enter retirement to protect gains. Major life events. Getting married, divorced, new child means re-evaluating your goals and risk level. Changes in financial situation. Job loss, inheritance, health issues could require a more conservative or aggressive stance. Market performance. Prolonged bull-bear markets may cause your allocation to drift from targets. Changing risk tolerance. As you gain experience, you may become more or less tolerant of volatility. While buy and hold is ideal, it's okay to tweak your allocation within your original risk parameters as your needs evolve. For example, shifting from 60/40 stocks, bonds to 55/45 or 50/50 over time. The key is making changes deliberately based on your situation rather than panicking over short-term market fluctuations. Stick to reallocating every 5-10 years or as major life events occur rather than frequent tinkering. With discipline, you can optimize your asset allocation for the long haul. In summary, asset allocation is one of the most important decisions you will make as an investor. By thoughtfully diversifying your portfolio across different asset classes based on your risk tolerance and time horizon, you can maximize returns while managing downside volatility. Sticking to your strategic allocation through disciplined rebalancing ensures you don't abandon your plan during periods of short-term market stress. While buy and hold is ideal, it's reasonable to tweak your allocation as your needs or risk profile change with major life events. The key is making adjustments deliberately rather than reacting to short-term noise. With the right implementation strategy using low-cost funds, ETFs, or automated services, your asset allocation plan becomes your blueprint for long-term wealth accumulation. By understanding the core principles of asset allocation and implementing a strategy tailored to your personal situation, you give yourself every chance of achieving your financial goals. With discipline and patience over the decades, a well-diversified portfolio can help you build a comfortable retirement and reach all your important milestones. In conclusion, asset allocation is the cornerstone of a successful investment strategy. By embracing this principle, you're building a strong foundation for your financial future. Remember, this is a journey, not a one-time decision. Stay informed, adapt when necessary, and always keep your financial goals in focus. Ready to start optimizing your investments through asset allocation? Start today by evaluating your financial goals and risk tolerance. Like, comment, and subscribe for more valuable insights to secure your financial future, and as always, stay financially savvy.